Okay, let's face it, getting into trading, especially crypto trading, it can feel like, oh, like just too much information flying around.
Oh, absolutely. Information overload is real. Everyone seems to have the secret indicator, the magic setup.
Exactly. And what you really want, I think, is just something clear, something reliable you can actually, understand.
That feeling's totally normal. So many strategies, so many tools.
Hmm.
It's easy to get paralyzed. But often, the best stuff, it's built on simpler ideas.
And that's exactly why this one caught our eye. We're doing a deep dive today into a specific trend trading strategy for crypto.
Right, and the source is interesting. It's a YouTube video.
Yeah, by Saya Crypto, and the title is pretty bold. I expose my best crypto trading strategy, easy 94% win rate.
Okay, yeah, that 94% win rate, it definitely makes you pause.
It does, but look, our goal here isn't really to verify that specific number. It's more about the approach.
Exactly.
Hmm.
The interesting part is the format, right? It's someone laying out a seemingly simple strategy, promising it works without needing like 50 different indicators cluttering your screen.
Yeah, it taps into that desire for clarity, which is huge in this space.
Definitely.
So for you listening in, think of this as us unpacking one specific method. We'll break it down, look at the core principles, and see what it tells us about market movement. No guarantees, obviously, but a clear look at one way to do things.
Okay, sounds good. So where do we start? What's the core idea?
Well, the creator really emphasizes simplicity. That seems to be the foundation.
Right. They argue that too many traders just get completely bogged down, indicator overload leads to confusion, bad decisions.
Analysis paralysis.
Exactly that. So this strategy aims to strip all that back and focus on the most basic thing, trends.
Okay, trends. Sounds fundamental, maybe even a bit basic, but that's the core. How do they define them? Uptrends, downtrends.
Yeah, they keep it really simple. An uptrend is just higher lows and higher highs.
Like bouncing a ball upstairs.
Perfect analogy. Each bounce is higher, and a downtrend is the opposite, lower lows, lower highs. Ball bouncing down the stairs.
Okay.
And they stress this applies everywhere. Bitcoin, Forex, whatever. It's just reading the price action.
So no complex formulas needed, just to see which way things are generally heading, just looking at the chart. But it's not just about one chart, right? This strategy really leans on multiple time frames.
Yes, that's a critical piece. You need context. Looking at different timescales gives you like the full story, helps filter out the noise.
Which time frames do they specifically mention?
They list 5. Weekly, daily, 4-hour, 1 hour, and then the 15-minute.
Okay, quite a few. And each has a specific job.
Each plays a role.
Yeah.
The weekly.
Eh?
But that's for the big picture.
The main market direction, like the strongest overall trend.
Precisely. It establishes your main bias. Think of it like the overall slope of a mountain range.
Got it. Sets the scene. Then the daily.
The daily is for confirmation. You check if it agrees with the weekly. If the weekly is bullish, you want to see bullish signs on the daily too. Adds confidence.
Okay, weekly for direction. Daily confirms it. Then we move down to the 4-hour. What's that for?
The 4-hour is interesting. It's mainly used to spot consolidation phases.
Sideways movement, when the market's not really trending.
Exactly. Like that Bitcoin example they gave, where it was stuck between, 27K and 31K for nearly 2 months?
Oh, yeah, I remember that period. It felt like ages.
Right. So the 4-hour helps you see those pauses, those areas where you might want to sit out because there's no clear direction. Helps avoid getting chopped up.
Okay, so identify the big trend, confirm it, then see if it's currently moving or just resting. Makes sense. Now, the action seems to happen on the shorter frames, the 1 hour and 15-minute.
Yeah, that's where the potential trades start to emerge. The 1 hour is where you look for the initial entry signal.
And that signal is a trend line break.
That's the key trigger. You draw a trend line on the 1 hour chart, maybe connecting recent lows in an uptrend or highs in a downtrend. When price breaks that line, that's your alert.
So break above a downward line means maybe go long, break below an upward line, maybe go short.
You got it. And they mentioned setting alerts, like on TradingView, so you don't have to stare at the charts all day, which is practical.
Definitely practical. They mention needing premium for lots of alerts, but the basic idea works even without it.
Yeah, they said the free version is fine to get started. The alert just tells you, hey, look now.
Okay, so the 1 hour alert triggers, trend line broken. Do you just jump in then, or is there more refinement?
There's one more step. Once that 1 hour alert goes off, you then drop down to the 15-minute chart.
Ah, zooming in even further. Why?
For a more precise entry, you look for the same kind of trend break confirmation on the 15-minute chart. It helps fine-tune the timing, potentially get a better price, and maybe tighten your initial risk.
Like double checking before you commit. Makes sense. Okay, so you've used all these time frames, you've found your entry. What about managing the trade? Risk is everything. Stop losses,
Hmm.
targets.
Crucial. They give a pretty clear example. Let's say you entered short around $29,200 based on that break.
Okay.
Your stop loss would go just above the recent high that formed before the breakdown, maybe around $29,500 in their example.
So you know your maximum risk up front. What about the profit target?
The take profit would go below a recent low, maybe around $20,800 in that same example.
Right, so you're defining both your risk and your potential reward.
Exactly. And you're aiming for a positive risk-reward ratio, like risking $300 to potentially make $400, or ideally even better, like 1 to 2 or 1 to 3 risk-reward.
Always aiming to win more than you lose on any single trade. That's fundamental. What about managing it once it's moving?
Yeah, they touch on moving the stop loss to break even.
Ah, the free trade idea.
Sort of. Once the trade moves nicely into profit, you shift your stop loss to your entry price. Yeah. So in that short example, move the stop from $29,500 down to $29,200.
Meaning if it reverses, you get out without a loss. Protects.
Precisely.
Yeah.
Removes the initial risk from the table. Smart move.
Definitely. Now, they also mentioned bringing the big picture back in when setting those profit targets, right? Connecting back to the weekly and daily.
Yes, absolutely critical. You need to set realistic targets based on that overall market structure.
How so?
Well, think about it. If the weekly chart is screaming bullish, like a massive uptrend,
Yeah.
taking a short trade on the 1 hour might be okay for a quick scalp, but you probably shouldn't set your take profit way, way down. You're fighting the main current.
Ah, okay. So the higher time frame trend suggests how far a counter trend move might realistically go, or how far a trend following move might extend.
Exactly. Trade with the dominant trend when possible, and be realistic about targets if you're trading against it. Align your expectations with the big picture.
So let's try and recap this whole thing. The strategy presented is about, first, identifying the main trend using those higher time frames, weekly and daily.
Your bearings.
Then, check the 4-hour for any sideways chop, any consolidation.
See if the market's actually moving or just resting.
Then you watch the 1-hour chart patiently for a trend line break as a potential entry signal.
Wait for the trigger. Patience is key there.
And once that triggers, you can zoom into the 15-minute chart for a potentially more precise entry confirmation.
Right, that final check.
And throughout, strict risk management, clear stop loss based on recent structure, clear take profit, aiming for good risk reward.
Yep. Defined risk, defined potential gain.
And always keeping that overall weekly, daily trend in mind when deciding how ambitious your targets should be.
That's a great summary. It really boiled down to simplicity, patience, and context, aligning short-term actions with the long-term picture.
It definitely sounds less cluttered than strategies involving tons of indicators. The focus is purely on price action and structure across time.
Which can be very powerful. But, of course, we have to say,
Oh, for sure. This is just one strategy presented in one video. It's not financial advice, and you absolutely need to do your own research, your own testing.
absolutely. No magic bullets in trading. Understanding takes practice, experience. This is just one framework to potentially explore.
Right. A framework built on observing trends at different zoom levels, which actually leads to an interesting thought to leave people with.
Oh, yeah.
Well, think about this principle analyzing things across different scales. The big picture trend, the medium-term consolidation, the short-term action. Where else could that apply?
Beyond trading, you mean?
Yeah, like in project management, maybe? Or understanding social trends? Or even personal development, thinking about your long-term goals versus daily actions.
That's actually, yeah, that's a really interesting way to think about it. Understanding the macro and the micro and how they interact. It's a pretty universal concept when you frame it like that.
Something to chew on anyway, looking at the world through different time frames.